Would you drop $750,000 for a few minutes of weightlessness because, well, people from over 20 countries are literally already putting down deposits to do exactly that?
It's pretty unbelievable when you actually think about it.
It really is. Welcome and thank you so much for joining us. Today, we are taking a hard look at the commercial space industry by unpacking Virgin Galactic's Q1 2026 earnings call.
Right, we've got a lot of material here. We're looking at their prepared presentation, the financials, and the actual transcripts of the analyst Q&A.
Yeah, we have a ton to get through. Our mission today is to figure out if space tourism is, finally moving out of the realm of science fiction and into a viable, functioning business model.
Okay, let's unpack this, starting with the actual physical reality of what they're building.
Because for years, it's just been like CGI and blueprints.
Exactly. But those days seem to be ending. They actually delivered their first new Delta-class spaceship to the test and launch hangar in Phoenix.
That physical delivery is massive. I mean, in aerospace, they just reached a milestone that everyone calls weight on wheels. Weight on wheels, so it's supporting itself.
Right, for you listening, this means the ship is no longer just a bunch of separate carbon composite parts propped up by scaffolding in an assembly bay somewhere. It is structurally complete enough to support its own mass.
Which is a huge deal.
It really is. It's physically in a testing facility now, which officially starts the clock on their timeline to commercial operations.
And the way they are handling that testing phase has completely changed. Like, it's highly decentralized now, which kind of feels counterintuitive for something as complex as a spaceship.
It does sound weird at first.
Yeah, because you've got structural testing happening under loaded flight conditions down at the Southwest Research Institute in San Antonio. Then you have software and avionics being validated over in Orange County. And then there's this Ironbird off-ship testing in Irvine.
Yeah, the Ironbird.
I really want to spend a minute on this because it sounds amazing. Think of the Ironbird like playing a state-of-the-art flight simulator, but instead of a monitor and a joystick, the simulation computer is hooked up to the actual physical steering columns, the wiring harnesses, and the flight sensors of the spaceship.
Yeah, it's wild. What's fascinating here is why this off-ship testing fundamentally changes the economics of building a spaceship.
Because they are basically spoofing the ship's brain, right?
Yeah.
Making it think it's pulling 4Gs to see if the software crashes.
Exactly, long before the physical ship ever leaves the ground. In the past, with their original prototype ship, Unity, the standard was essentially build and test. A lot of the hardware had to be physically installed into the airframe before they could thoroughly test the integrated systems.
Which just sounds so inefficient.
It is. I mean, if a single valve didn't work or you had a software glitch, you had a multi-million-dollar bottleneck just sitting in a hangar while engineers scrambled to fix it inside this cramped fuselage.
Oh man, yeah. So now with the Ironbird.
Right. By investing in this off-ship infrastructure, they run individual components through extreme temperature, vibration, and software tests entirely independently. It radically shifts the paradigm from build and test to simulate and verify. By the time a part actually goes into the physical Delta ship in Phoenix, they already know it works flawlessly.
So it completely removes the bottlenecks that used to paralyze their production line.
Exactly.
Well, that context makes their really aggressive timeline make a lot more sense. Because they are simulating so much off-ship, they expect integrated vehicle testing, which is checking the end-to-end performance of the fully assembled ship, to start in June of this year.
Wow, that's fast.
Yeah, and then glide flight testing begins in Q3 of 2026. Oh, and here's a cool little detail from the notes. The original prototype, Unity, is actually making an encore performance in May.
Wait, really? I thought they retired it.
They aren't putting it in a museum just yet. They're using it as a real-world proxy to train their expanding roster of pilots. All of this momentum is pointing directly toward commercial operations in Q4 of 2026.
Well, and if you're going to launch a commercial service in Q4, you can't just have one ship. You need the supply chain to feed a fleet.
Good point.
That's why they highlighted the construction of a new rocket motor assembly line, also in Phoenix. It's expected to be operational in Q4. You just cannot ramp up your flight cadence if you are waiting around on external vendors for your engines.
Right, bringing it in-house is critical.
Scaling that up is the operational step that proves they are preparing for volume, not just test flights.
All right, so the hardware is moving, but building factories and spaceships burns through capital, like a lot of it. Let's see how this shift from development to manufacturing is actually showing up in the financials.
Sure.
Looking at Q1 2026, their total expenses dropped 26% year over year down to $66 million. The net loss improved by 23% to $65 million. and free cash flow improved 23% to negative $93 million.
Those numbers are incredibly revealing. In aerospace, there's something called the Valley of Death.
The Valley of Death, that sounds intense.
It is. It's that period where a company is burning hundreds of millions of dollars to figure out the physics of their vehicle, but they have absolute zero revenue coming in. These dropping expense numbers tell a very specific story. The peak spending for R&D is officially in the rearview mirror.
So they survived the valley.
Basically, yes. They are transitioning from the highly volatile, expensive phase of inventing a spaceship to the relatively predictable phase of just manufacturing it.
But, the market reaction was actually a bit mixed. Looking at expectations versus reality, Q1 revenue came in at $227,000, which beat analyst estimates of $200,000 by about 13.5%. But earnings per share was a slight miss, negative 81 cents versus the negative $1.79 estimate.
Right.
And following the report, the stock price moved down slightly by 2.43% to $2.81.
Which isn't entirely surprising. You often see slight market corrections, even with a revenue beat, when you are looking at a pre-revenue company. Wall Street knows that the current trickle of income is just from, future astronaut membership fees or merchandising.
Yeah, selling T-shirts doesn't fund a space program.
Exactly. The market is waiting for the operational revenue engine to actually turn on.
Let's talk about how they survive until that engine turns on, because liquidity is everything right now. They ended Q1 with $251 million in cash, but they supplemented that cash burn with a $52 million at the market, or ATM equity offering in April.
Yep, the ATM offering.
Now, I have to push back here on behalf of you listening, because an ATM offering means they are issuing new stock directly into the market. That dilutes the value of existing shares. If I'm an investor, they just made my slice of the pie smaller. Is that dilution a red flag that the business is struggling?
It is a vital question, and it is the very first thing analysts scrutinize. But context matters here. The CFO specifically defended this move by pointing to the balance sheet. That $52 million isn't disappearing into some black hole of administrative bloat.
Right.
It is being converted directly into hard, revenue-generating assets, capital expenditures. We're talking about the physical carbon fiber spaceships and that new rocket factory.
So they have something to show for it.
Exactly. Their property, plant, and equipment assets have swelled to $427 million. So yes, there is shared dilution, but the underlying business is trading paper equity for the physical infrastructure required to actually launch the service. It's a necessary trade-off to cross the finish line.
Okay, that makes sense. They also retired $10 million in 2028 notes early, which cleans up the debt profile a bit. Looking ahead at future guidance, Q2 revenue is expected to be around $100,000 with a free cash flow sitting between negative $87 and negative $92 million.
But Q4 2026 is the real horizon.
Right. By then, they expect operating expenses to drop dramatically, down to between $70 and $80 million per quarter.
And that drop is what makes their long-term business model viable. They're targeting an average ticket price of $600,000 moving forward. Because this is a highly reusable spaceplane, the unit economics are just staggering. They are projecting contribution margins of over 80%.
Okay, hold on. Wait. 80% margins on spaceflight. That sounds almost too good to be true, considering aerospace is notoriously difficult and, rockets literally explode. How do you get 80% margins? Are they underestimating the maintenance costs?
It sounds super high until you look at the architecture. Virgin Galactic doesn't use a massive vertical rocket. They use a mothership.
Like a specialized airplane.
Right. It carries a smaller spaceplane up to about 50,000 feet before dropping it. The spaceplane then ignites a relatively simple hybrid rocket motor to reach space. The 80% margin works because the variable cost per flight, the fuel, the pilot salaries, the turnaround maintenance, are incredibly low compared to a traditional rocket launch.
Oh, I see.
If you have a cabin of 6 people paying $600,000 each, that is $3.6 million in revenue for a flight that might only cost a few $100,000 to actually run.
Wow. The revenue vastly outweighs the variable cost. But only if they can fly frequently, right? Well, the plan relies entirely on volume. Their flight cadence is planned to ramp up from 4 flights per month in January 2027 to 8 flights per month by Q2 of 2027.
That's the goal.
If they hit those numbers, management expects modest positive cash flow within 2027. By 2028, they anticipate hitting positive annualized adjusted EBITDA. For those outside of finance, positive EBITDA basically means the core day-to-day business of flying people to space is finally sustaining itself and generating a profit.
Exactly. It is entirely a volume game. They have massive high fixed costs to build the factories, but incredibly low variable costs per flight. If they fly 8 times a month, the cash machine turns on. If they suffer delays and only fly once a month, the math just falls apart.
Which brings us to the most revealing part of any earnings call, the analyst Q&A. This is where leadership has to drop the scripted optimism and address Wall Street's immediate anxieties.
Yep, the gloves come off.
They grilled them on everything from SpaceX comparisons to how VIPs are apparently paying massive premiums to jump the space waitlist. We are calling this the Space Economy Tracker segment of the deep dive. So if you are finding this breakdown helpful, please click like, share the video, subscribe, and stay tuned, because what these analysts uncovered shows exactly how this luxury market is going to function.
The Q&A is crucial. The presentation is about the destination, but the Q&A is about the bumps in the road.
Let's get right into it. Wall Street is clearly trying to figure out who is actually buying these tickets. When Oliver Chen from TD Cowen pressed leadership on the nature of early bookings, the answer was surprisingly diverse. The CEO explained they aren't just seeing stereotypical tech billionaires. They are booking girls' trips, family vacations.
And foreign governments, which is huge.
Oh yeah, foreign government.
That demographic is key. For a foreign government, buying a $750,000 seat on a Virgin flight is a cheap way to instantly create a national space program.
Like an off-the-shelf space program.
Exactly. Or they can conduct microgravity research without having to spend billions developing their own rockets. The company noted that the current tranche of tickets at $750K will likely sell out by Q3, and they bluntly stated the next batch will be even more expensive.
Oliver Chen also pushed them on how the manufacturing of the second Delta ship is going compared to the first.
The response there was highly technical, but very reassuring for investors. Leadership stated they have, quote, figured out the recipe for their carbon composite parts.
What does that mean practically?
Well, the first time you build a carbon fiber spaceship, you have manufacturing clashes. Parts don't fit perfectly, molds have to be tweaked. For the second ship, the process is coming together significantly faster and cheaper because the non-recurring engineering is done.
Ah, okay.
They also addressed that ATM equity program you asked about earlier.
Right.
The CFO noted they have about $87 million of runway left on that program, and it will be used strictly for growth, capital like tooling up the rocket factory, not basic survival.
Chen then pivoted to the elephant in the room, SpaceX. Given the general public enthusiasm for Elon Musk's ventures, he asked how Virgin Galactic is differentiating itself and what their strategy is for securing recurring revenue.
And leadership drew a very sharp line here. Virgin is laser-focused on human spaceflight experiences at a much lower price point. A ticket with Virgin is $750,000. If you want to fly with SpaceX to the International Space Station, that costs upwards of $50 million.
And it's a completely different physical experience,
Yeah,
right?
entirely. SpaceX is building heavy infrastructure to reach orbit and eventually Mars. It involves days in space, immense G-forces, intense physical training. Virgin Galactic is offering a suborbital experiential platform. You go up, experience a few minutes of weightlessness, see the curvature of the Earth, and glide back down to a runway in time for dinner.
Yeah, adjacent industries, but completely different markets. And as for recurring revenue, Virgin pointed to the U.S. government. They highlighted their qualification under the government's Golden Dome IDIQ contract for DoD ride-along payloads. An IDIQ is basically a pre-approved vendor list. It means the Air Force can essentially use a government credit card to easily purchase space on Virgin flights for rapid research without going through years of procurement red tape.
Which provides an incredibly stable, high-margin revenue stream alongside the tourism side.
Now, let's talk about the wait list, because this is where the economics get slightly controversial. Greg Conrad from Jefferies wanted clarification on the ticket pricing mixture. Years ago, early adopters bought tickets for $200K to $250K. Now tickets are $750K. He wanted to know how they plan to fly these different tiers.
Yeah, and the impact on margins.
Exactly. Here's where it gets really interesting. The company confirmed they will honor those early $200K tickets on a strict first-in, first-out basis starting in early 2027. However, they introduced a program where VIPs can pay a massive premium to jump the line.
It is a brilliant, albeit ruthless, revenue management strategy. If a high-net-worth individual doesn't want to wait 5 years behind the original backers, they can pay well above the current rate to guarantee they are among the first 1,000 astronauts in space. And the CFO made a crucial point here. Any ticket sold above their $600,000 baseline model flows as 100% incremental profit straight to the bottom line. The cost to fly the ship is fixed. So if someone pays an extra $400K to skip the line, that entire premium goes directly to making the company cash flow positive faster.
It's the ultimate fast pass lane. But to fly anyone, they need government permission. Miles Walton from Wolf Research asked for an update on the FAA Part 450 licensing.
Oh yeah, the Part 450.
Right, it's the FAA's new, highly rigorous, unified licensing regime for commercial space operations. It is notoriously difficult to secure.
It is the ultimate regulatory hurdle. The company confirmed that the FAA has officially accepted their Part 450 operator's license application. The clock is ticking, and they expect to receive the full license before they begin powered flights in Q4.
Okay, that's reassuring.
They did clarify that while their individual ships require recurring experimental airworthiness certificates, those renewals have never been a bottleneck. But getting that primary Part 450 application accepted is a massive de-risking event. It proves the government is actively validating their safety frameworks.
Walton also asked if the DoD was looking to make direct equity investments in Virgin.
And leadership shut that down pretty quickly.
Yeah, they clarified that while their new Chief Growth Officer, Megan Pritchard, is in active talks with Defense and Air Force research labs, the focus is on sponsorships and partnerships for payloads, not direct government ownership of the company's stock.
The government prefers to be an anchor customer, not a shareholder.
Makes sense. Finally, we got a glimpse of their global ambitions. Christine Leewag from Morgan Stanley asked for an update on the potential spaceport in Italy. I loved this detail because it shows how complex airspace actually is. The company announced that the structural airspace deconfliction work with ENIC, which is basically Italy's version of the FAA, is completely finished.
That is no small feat. Italian and broadly European airspace is incredibly crowded with commercial flights. Figuring out how to safely launch and land a spaceship through those commercial flight corridors is a massive technical puzzle.
Absolutely.
With that solved, the next phase in Italy is strictly about finalizing the business model and the timing of a public-private partnership.
And it isn't just Italy. Leadership revealed they are in advanced talks to establish 3 to 4 permanent spaceports globally.
If we connect this to the bigger picture, the Italy spaceport isn't just about adding one cool new destination. It is about proving a franchise model.
A franchise spaceport.
Exactly. Virgin Galactic spent the last decade and hundreds of millions of dollars doing the hard, non-recurring engineering. They figured out how a spaceport works safely. Now, rather than paying to build new spaceports themselves, they can export that blueprint as a franchise. Foreign governments pay to build the physical infrastructure, and Virgin Galactic simply brings the ships and operates the service.
So, what does this all mean? If we look at a high-level wrap-up of this entire discussion, 2 major themes really dominate both the presentation and the Q&A. First, the notoriously dangerous valley of death in aerospace R&D is finally transitioning into repeatable manufacturing. We can see it in their declining R&D expenses, the off-ship Ironbird testing, and the physical delivery of actual hardware.
Yes, that transition is yielding real financial and operational visibility for late 2026.
And the second major takeaway is the sheer power of their unit economics. When you have a reusable spaceplane architecture, an 80% contribution margin, and a wealthy global customer base willing to pay a premium to jump the line, the math is undeniably compelling.
But, and this is the critical caveat that investors are watching, it all hinges entirely on flawless execution. They have to prove they can consistently ramp up to that cadence of 8 flights per month without safety stand-downs or manufacturing delays.
Exactly. The demand is clearly there. The financial models work on paper. Now they just have to consistently fly the ships. And that leaves us with a final thought for you to mull over. We are talking about girls' trips to space, VIPs paying hundreds of thousands of dollars just to skip a wait list, and 3 or 4 permanent spaceports opening up around the world.
It's quite a picture.
It really is. Once Virgin Galactic is launching from Italy and other global locations multiple times a week, does space travel remain the ultimate, prestigious, exclusive club for humanity's elite? Or does it eventually just become another luxury tourist destination, like booking a high-end safari or a private yacht?
It is a fascinating paradigm shift in how we view the cosmos.
It really is. The barrier to entry is dropping, and the sky is literally no longer the limit. Thank you so much for tuning in. If you enjoyed our breakdown today, please click like, share the video, subscribe, and stay tuned for upcoming content. We will see you next time.